Congratulations. Last chapter, chapter 14, cash flow statements. Let's talk about the big picture, and then we'll focus on what a cash flow statement is all about and why you might want to use it and how you might want to make one. So you recall balance sheet. Three things: assets, liabilities, equity. There's our balance sheet, and we're in good shape when we have assets equals liabilities plus equity. You remember this fondly, I have no doubt, from financial accounting. Debits to the left, credits to the right. We have our income statement. We have revenues on the credit side. We have expenses on the debit side. Ideally, a positive net income. We're good to go. Okay. Point in time, period of time. Point in time, cash today makes a lot of sense. Inventory, December 25th or December 31st makes a lot of sense. Inventory for the month of December makes no sense. You can't count the shelf for the whole month. You have things coming in and going out all the time. As opposed to revenues and expenses. My rent for the year, my revenue for the year makes sense. If I asked you what's my rent for the December 31st, you say, well, is that the day December 31st? Or is that the month ending December 31st? Or again, point in time doesn't make any sense. But now we have a cash flow statement. And the cash flow statement is also a period of time. We start with beginning cash, and then we have sources or inflows, which are increasing, and then we have uses of cash or outflows, which will decrease. And then we have an ending cash. The powerful thing is your beginning cash better match your balance sheet cash at last year's year end. So January 1st versus 12/31, no difference essentially. So we're talking a 12/31 balance sheet from last year would be a beginning cash flow. A 12/31 ending balance will be the current year's ending balance to match. So this is the big picture of a cash flow statement. So what goes on a cash flow statement? Well, there are three things we need to be concerned with and be aware of. And I can't think of a better acronym than OIF. It's a terrible acronym. It's not oil. It's not OIV. Some may feel that. So what is OIF all about? Well, you can probably guess at least 2 out of 3, if not all 3, hopefully. So we have cash flows from operations. We'll talk about in a minute. We have cash flows from investments. And finally, we have cash flow from financing. Why are each one of these important? Why are they distinctive? What's separate and useful about these? Well, if I asked you what is the best predictor of future performance of an organization, would it be operations, investments, if I can spell investments right, or financing? You'd say, well, some days I attract investors, we issue debt, we sell stock, but that doesn't mean I'm going to succeed. That doesn't mean my business will be successful. It just means I can attract investors. We can make investments. We can buy equipment. We can buy other businesses. But buying stuff doesn't necessarily mean we are successful. What is important is the operations for the future. You say, well, that's how I make my money. I'm Amazon. I sell stuff. I buy stuff, and from what I sell and buy, I make. My service stuff, my cloud stuff, I sell services, and that's what I make. By buying computers, setting up massive computer banks, that won't determine my success. It contributes to my success, but I can't predict my success based on how many computers I buy. I can't predict my success based on my stock price. It's what other people think its value is. So when they buy my stock, I like that. I mean, you know, Amazon lost mega bucks the first 7 years. Every year they were losers. People still invested in them and are multimillionaires, those that did. But the fact is, operations is the best predictor. So we're going to focus our analysis when we talk about our cash flow statement on looking at all 3 of these categories and finding out how to write up a cash flow statement. A cash flow statement, you could say, well, I could just look at my income statement and say, yeah, I got cash in, I got sales, I got cash out, I got expenses, I wrote the checks. And doing it on a cash basis, not accrual basis, is going to be kind of important to do that. Then I can come up with my cash. Or I just look at my checkbook. Every check I write is a cash outflow, a use of funds. Every check or deposit I receive, even cash I receive, is a source or inflow of funds. So I can say, I can look at all my bank registers and say, what is all my cash going in and all my cash going out? That's a high volume of transaction. And actually, that's a mess. So I would not encourage that to be your technique in doing a cash flow. That's called a direct method. My direct cash in, my direct cash out. Easy to understand, but in a practical matter, really tough to do. So we're going to use a balance sheet-based cash flow statement. And it's called the indirect method. We're going to look at changes in assets, changes in liability, changes in equity, and determine by categories. So when we talk about that, we're going to take a look at how this comes together based on those changes. So as you can see from the slide posted right now, we've got OIF, we've got operating, investing, and financing activities. And as we discussed, operating is going to be the best predictor of future success of an organization. And there are some ratios that take into account cash flow from operations. And that's what we'll be looking at. So how do we differentiate between these on an indirect cash flow statement? Well, in the case of operating, as we said before, revenue, expenses, transactions that affect net income. Where do most of those transactions fall? Well, those would be really current assets, current liabilities. We'd have changes in inventory, receivables, payables, obligations, things we pay. How does investing fit into the picture? Well, investing is acquiring or disposing of non-current assets. So we look at our long-term assets and we say, oh, we bought some equipment. We bought some vehicles. We acquired some intangible assets, some copyrights, some patents. We might even invested in might have bought our competitor, or upline or downline, that vertical monopoly stuff that you've learned about in economics. We might have bought a supplier or an outlet for our stuff, channel. So if Amazon buys Whole Food Market, and well, it's another business, that's an investing activity. They invested in Whole Foods and bought them. Then we look at financing activities. As you can see from the slide, borrowing from and repaying principal to creditors and transactions with stockholders. So debt, bonds payable, mortgages and loans, as well as equity transactions, sale or repurchase of stock, treasury stock, or just selling stock in the marketplace. So those are the three categories, and the changes are going to be balance sheet changes for our indirect statement. So let's come on back to the whiteboard. Looking at the board, yes, we've got our balance sheet, and we mentioned things like current assets and current liabilities are going to be operations. We mentioned long-term assets or non-current assets are going to be our investments. And we mentioned long-term debt or non-current liabilities and equity, common stock, et al., all the good stuff that goes with that, additional paid-in capital and whatever else we might have, are considered financing transactions. Financing, investing, operations. As you recall, I'm going to make again a quick review of our debits and credits world. If you recall, you look at your debits and credits, left, right. If you increase an asset, there's a debit. Decrease an asset, credit. Okay, basic accounting. Increase the liability, there's a credit. Decrease the liability, there's a debit. All right, this should be old hat by now. Same thing for equity. Okay, so credit, debit, increase, decrease. You recall that we actually drew the picture of our revenues and expenses. And we were looking at being able to say, well, increase in revenue is a credit, decrease in revenue is a debit. And increase in expense, this is on the debit side, left side is a debit, decrease in expense is a credit. All right, so far so good. That's our basics of debits and credits. We're going to have something similar when we do a cash flow statement. And again, we're looking at our OIF model. And you start saying, well, if I buy inventory, okay, so I put my inventory right there. Is that a source or a use of funds? So I've got an asset, and I happen to be increasing my asset. Don't worry about cash. The cash is the only thing not included in current assets on a cash flow statement because that's what we're calculating. So we're looking at receivables, inventory, prepaids, all the good stuff that goes in. So if my inventory goes up, how am I getting my inventory? I must be spending money to do it. So if my asset's going up, we're using funds or decreasing cash to do it. Well, how about if I'm decreasing my assets? Well, let's look at a decrease of assets. Let's take receivables, for example. So how does my receivables decrease? Oh, somebody pays me. I debit my cash, and I credit my accounts receivable. Okay, I reduce my accounts receivable, I increase my cash. So what's happening to accounts receivable? My accounts receivable is decreasing, but my cash is going up. So if my asset is going down, it's a source or an increase in cash. All right, we can handle this. So let's talk about liabilities. What happens if I am increasing my liabilities? Well, better still, it's easier to see with accounts payable. How does accounts payable decrease? Well, accounts payable decreases when we write a check. Credit cash, debit accounts payable goes down, cash goes down, we're on our way. So if we write the check, if we decrease the liability called accounts payment, that is a use of cash. Our cash goes down. Okay. If we take out a loan, short-term loan, we go to the bank, you know what, I've got payroll, I've got a line of credit. You know what, I need $50,000 to cover my payroll this 2-week period. So line of credit, let me tap it. I'll give you $50,000 cash, and you'll take on a short-term note payable, liability of the bank. Draw on your line of credit. So I increase my current liability. I also increase my cash. So an increase of liability is a source of cash. Increase of cash. So we've been using all these operating examples so far. Let's talk about investment example. Let's go ahead and buy a building or a piece of equipment. We go out and buy that building or equipment, what happens? Our assets go up. How are we going to get that equipment? Well, we're either going to finance it, we'll talk about in a second, or we'll go ahead and use money to do it. We'll decrease our cash and write the check and go buy a building. Well, does that fit our model so far? Well, my assets went up, my long-term assets or non-current assets went up, my cash went down. Yeah, I wrote the check. Fits our formula. It seems to work. How about on the financing side? We issue bonds. We put out a $10 million 5% bond issue, 20-year bonds. We get $10 million non-current liabilities, bonds payable. We get $10 million in cash. Thank you very much. Yeah, we have to pay interest every 6 months. Yes, we'll have to pay the principal back at the end of 20 years. But what's going to happen? We got cash right now, and we got a bond payable. We increase our liability. Oh, yeah, that makes sense. My cash went up. It's a source of funds. I pay back that bond 20 years from now. My $10 million, I write the check. That's a use of funds. How does that work in equity? Well, I got equity. I'm going to increase equity. I'm going to issue more stock. I'm going to sell more stock. Well, I sell $100 million in stock. I get $100 million in cash, or stock and additional paid-in capital. So just like our debit credit form, yeah, it's the same thing here. Liability credit, equity credit. Yeah. Liability source, equity source. Okay. And a decrease in equity. Treasury stock. We go buy some treasury stock. We decrease equity. Sure enough, we had to use cash to buy it. Credit the cash and debit the treasury stock. That's why treasury stock shows up negative in the equity section of most balance sheets, because we had to buy it. Use of cash. Cash is down. This is almost all you need to know to prepare a cash flow statement using the indirect method. Almost, I say. We're almost there. But this is the key. This is the core. Because you're going to analyze your change in receivables, change in inventory, change in prepaids, change in current assets, change in non-current assets. Long-term assets, every change, that difference is going to be either added to the cash or subtracted from the cash. Same thing with liabilities, current, non-current, and finally equity. So you're going to go through your balance sheet, and that's all you need to do. That's going to analyze cash. So as you recall, we had a beginning cash balance, and we have an ending cash balance. And what's the gobbledygook in between? Well, what is our starting point? Okay. Let's go over and take a look at the slides. Okay, so we're looking at the statement of cash flows using the indirect method. We have our three categories of operating activities, investing activities, and financing activities. And you can pretty quickly see that under operating, we just talked about this, changes in inventory, changes in receivables, changes in payables, accrued liabilities, income tax payable, any payable that's there, everything on a balance sheet is going to be tracked. And we get some increases and we get some decreases. We also have investing activities, adding property, plant, and equipment, PP&E, proceeds from a sale. We'll talk more about that, and we'll talk about gains and losses as well down the road. And then net cash provided or used in investing activities. And then we have financing activities. We retired bonds. We wrote the check. We issued common stock. We got some money in. We paid dividends. Oh yeah, that's a change to equity. That's a change to our retained earnings. So we have net cash provided or used by finance activities. So how do we read this thing? Well, under operations, cash provided by operations, and see, dollars are in millions, so we have $259 million from operations. Now that's not necessarily net income, but it's actually a cash flow amount. But we also invested $130 million negative. We also had $67 million negative out of equity, including dividends and bond retirement. So we had net increase in cash and cash equivalents, a net of 62. We had our beginning cash of 29. We had our ending cash totaling 91. So ultimately, we had positive cash flow from what was going on. But let's take a little closer look at the beginning of this cash flow statement. What did we start with? Did we start with changes in receivables, payables, inventory? Actually not. We started with net income. We started with GAAP net income. That is our net income straight off the income statement. And then we had to convert to a cash basis. So we had some non-cash items. As you probably recall, depreciation and amortization, we don't write a check for depreciation, do we? Amortization of intangibles, you know what, patents, we're going to amortize, we don't write a check for that either. It's a purely adjusting entry. It reduces our net income. We take off the depreciation expense, we take off the amortization expense. So to correct or adjust our income statement to get our cash back, we have to go in and say, oh, wait a minute, I need to add my expense, depreciation expense. I need to add amortization expense, because those are things we deducted from net income that need to be added back. They have nothing to do with cash flow. They don't affect our cash flow. So by adding that back, in this case just the depreciation, that's the point we start at. We have our net income, add back our depreciation, and we're on our way. Then we go down the balance sheet, line item by line item, and make the adjustments. So the next key concepts I want to review with you, and there are 4 key concepts I want to touch base on. The first we've talked about, and all 4 we've talked about. But if we're looking at the statement of cash flow, we have our OIF, operating, investing, and financing activities. And so by now you should have a pretty decent handle on what that means and what that translates to. Then we have our net increase and decrease in cash and cash equivalents, beginning cash and cash equivalents. Take out the word cash equivalents and that's just clear. And we have an ending cash balance. Now with GAAP, Generally Accepted Accounting Principle, US GAAP, and International Financial Reporting Standards, IFRS, we have two methods for preparing, the direct and indirect. Most companies seem to use indirect, which is why I started stressing that directly. But conceptually, the direct method actually makes sense too. We've got cash receipts from customers, inflow. Cash paid for inventory purchases, outflow or uses. Cash paid for SG&A, selling general administrative expenses, or S&A, outflow. Cash paid for income taxes, outflow. So a net cash provided or used in operating activities, totaled. Then we have the net income, various adjustments. We actually have the cash provided or used in operating activities. As far as our indirect method, we're going to go ahead and look at net income. And we saw that our net income is our starting point from operations. That's what we did. We adjust to convert net income to a cash basis by adding back depreciation and amortization. We look at changes in non-cash accounts, not the cash accounts on the balance sheet, but the non-cash. So current assets increasing is a use. Our receivables goes up, we're actually financing our customers. Our inventory goes up, yeah, we're buying it. Decrease in current assets, somebody pays their bills, that's a source of funds, increases our cash flow. Increase in current liabilities, well, again, that is a source, that increases our funds. Accounts payable, and when we write our check for accounts payable, we're reducing, but when we're generating accounts payable, we're letting somebody else finance our operations. So we say, send us some stuff, I'll pay you in 30 days. During that 30 days, we're borrowing money from them. That's an increase in cash flow. Decrease, we write the check to pay the payable. We also have adjustments for gains and losses. The same way depreciation is a reduction, we have a a gain on the sale of an asset. You say, I made a gain, I made some money, didn't I? You sure did. What did you do with that gain? You put it on your income statement as a positive number. Is that gain cash flow? Well, you probably got some cash, which we'll throw into investing activities in a minute. But the actual gain itself has to be deducted. If we don't deduct the gain, our net income is including stuff that's non-cash items. So the same way deducting depreciation is appropriate, and I think you have a handle on that by now, we also need to deduct the gain on sales because it was added to our net income. We need to deduct it to compensate to get it out of the picture. The corollary is we had a loss on sale. So we sold this asset, on the books we lost money. We had a $100,000 piece of equipment, we had depreciated 90,000 of it, and we had a fire and lost the rest of it. Or we sold it for zero. We said, if you can remove it, you can have it. So that $10,000 loss was recorded as a loss on our income statement. So we need to go back and say, all right, so we had that loss, we got to add that loss back to our cash flow statement from operations. And we'll come up with net cash provided by operations. By the way, under a column, this is a good technique when you're writing down numbers. The first number in a column has a dollar sign. The last number in a column has a dollar sign. None of the other items in between have a dollar sign. That's one of those the old accountants say, in good form? Well, this is good form. You'll also notice there's single underlining for subtotaling and totaling. The bottom line in the column is double underlining. So we have two double underlines, one under key concept 3 and key concept 4. I don't test on that, but again, that's handy when you're dealing with accountants. And if you choose to be an accountant, you're going to put a dollar symbol in the top line, a dollar symbol in the bottom line, double underlining on the bottom line, and you're good to go. Finally, key concept 4, investing and financing activities. So we have cash provided by operations or used by operations would be a negative number in parentheses. We have our investing activities. Purchase property, plant, and equipment. Again, this should be a review, but if we are increasing our asset other than cash, we must be using cash to buy it. So that's the easiest way to think about it. So we're buying or acquiring or purchasing PP&E. That is a use or a negative effect on our cash flow, use of funds. We sold equipment. Oh, so that's where the sale gets recorded. We have a sale of property, plant, and equipment. All right. Purchase of long-term investments. We wrote a check. Bought some investments, long-term investments. If we sold them, yeah, we got some cash flow in. So again, we have cash provided or used by investing activities. Finally, in financing, we issue bonds. Let's see, we issue bonds. We issued $20 million in bonds. That means somebody wrote us a check for $20 million. That's a source of cash. That's a source of a lot of cash. We repay principal on bond payable. 20 years later, we write the check. Issue common stock. We get some money for that. We treasury stock. We buy our own shares back. Cash flow out. We pay a dividend. Obviously, we're writing a check. Now we have cash provided and used by financing activities. And finally, we have increase, decrease cash and cash equivalents, beginning cash and cash equivalents, ending cash and cash equivalents. That's our cash flow statement. Well, that takes care of most of what we had to discuss here. And again, just a final pointer, again, gains and losses, just to highlight it. GAAP and IFRS gains and losses must be included in investing section. Okay, so gains and losses in the investing section of the cash flow statement. And they must be removed from the income statement. So the operating activity section where we adjusted before, just in the previous example, we subtracted our gains and added our losses. So when you sell a fixed asset, you say, oh, Scott, I know what that is. That's investing. I sold this asset. I sold the building. But again, we have to go back to our operating section because it does affect operations in our cash flow statement as well. So it's going to show up in two places. And I wanted to highlight that because that can sometimes be confusing. You say, I sold an asset, it's just investing, right? Well, again, we have to adjust the income statement to get it where it needs to be. One other thing I want to talk about before we conclude today. So as we conclude, the last thing I want to talk about is something called free cash flows. I know nothing in life is free, but free cash flows are an important analysis point, part of your ratio analysis, part of your evaluation of a business, saying how much free cash do I have? What can I do with it? Well, we calculate free cash flow by taking a look at cash provided by operations. And so by now, you have a pretty clear understanding, hopefully, of what that is. Not cash provided or used by investments, not financing, but specifically cash provided from operations. And normally that's going to be a positive number because, yeah, hopefully we're profitable and we got more cash coming in than going out for the stuff we do. If a number of you are interested in real estate businesses live and die on cash flow. Yeah, the interest rate's kind of important. The amount of debt's kind of important. But you're going to look at what my monthly payments are, what my monthly expenses are, and from that, you're going to determine, do I have a positive cash flow or a negative cash flow? What's nice about real estate is if you have a positive cash flow for the next 15, 20 years, your mortgage is paid off and the asset's gravy. Or you actually take out more loans on that and build off of that. So we start with a cash provided by operations. And there are two things we need to deduct to say, well, what's our free cash flow? Well, we take out our capital expenditures. What do we spend for equipment? Capital stuff. Expenditures. Okay. So we take out our cash expended on capital expenditures, and we also take out our dividends. What does that mean? Well, we bought some stuff, and we paid dividends to our investors, to the owners of the company or the organization. So that leaves a net free cash flow. So why is free cash flow important? So it tells us how much funds are available after expenditures, after dividends, that are available from our operating activities, and then we can do other things. Free cash flow, we might invest it elsewhere. How much money do we have left to make additional investments? How much money do we have left to give back in dividends to our owners? So free cash flow is kind of a key element in understanding why we do a lot of this stuff. And there are other formulas that are used, and we're going to do a ratio video, kind of a bonus video for you, if you'd like to learn more about accounting ratios and financial ratios. Not actually tested in this course, it's actually in the book. It's in our next chapter, chapter 15. We're doing chapter 14, cash flow statements. So if you want to review that, financial analysis, I'll tell you one thing you can do is differentiate yourself on an interview. I tell my students all the time, how many of you have a grade point average? Yeah, I got a GPA. How many of you have a major? Well, I got one of those too. Some of you might be double majors. How many of you worked while you're in school? Well, you all work probably summers, or some are working half-time. A number of you are working full-time. And that's to your credit. And full-time actually is something that an employer might look at. And they can look at it good and bad. They can say, if you're working full-time, you can't devote time to your studies. That's confusing. Or you're dedicated, you're funding your own education, and you're working, you always give your work to a busy person. I think it's more of a positive. But people can look at two sides of every story. So we're looking at, in interviewing with a company, and you say, if you ask this question, I noticed for the past 3 years, your revenues have been going up, but your profits have been going down. What's going on? Well, that means you read their financial statements. That means you did a little more due diligence, a little more analysis, actually more analysis than 95% of the people that looked at the website, Googled the name, found out what Amazon is doing to raise Amazon Prime monthly payments or whatever's going on with that. They're going to go through and say, wait a minute, you looked at our financials? You did some analysis? Who does that? Well, you did, and you have a better shot at getting the job. So if you ask those kinds of intelligent questions based on financial statements and reviewing a company's financial, and if they're not publicly traded, you do it for a competitor. I'm not going to work at Best Buy, but you're a local provider. You've got home entertainment, you've got washers and dryers. I know it's Best Buy sales are doing this, and their profit margin's been going down, their cost of goods sold has been going up as a percentage of revenue. Is that an industry standard? You're looking at our industry beyond our company? You actually did your homework. And that will set you apart in an interview. You'll be ahead of the game of 90-95% of your peers that are interviewing for the same job, that have a major, that have a GPA, that worked, probably played a sport, and have some other things. You want to hone in on what's different about you, things you've done, and if you're preparing, what difference preparation can you make? So that's my tidbit on interviewing tips and techniques. And as you know, I'm a LinkedIn advocate. You want LinkedIn on all your resumes, you want LinkedIn on all your email signature blocks, and that's another differentiator. If someone sees CPA on a resume on mine and not CPA on somebody else, they'll say, all right, that's a step in the right direction. If someone says PhD versus master's, or DBA versus master's, okay, they like the doctorate a little better usually. Sometimes accountants, they don't like the master's, by the way. They say, I got to pay somebody with a master's more? I'd rather pay for the bachelor's. And again, it depends on the firm, depending on the general attitudes of the organization that you're interviewing with. So these interviewing tips and ideas, and you're welcome to call me anytime. I will let you know I do give a warranty on this course. You get a lifetime warranty. My lifetime, not necessarily yours. But the warranty is if you ever have a business question, if you ever have an accounting question, if you ever have a business need and you want some free consulting, my phone number is 608-446-1000. I've had that for probably 20 odd years, and I'll probably have it for another 20 plus years. So you're welcome to give me a call, and I'm happy. You pay a lot of money for tuition. You invest a lot of time in this course. So it's my pleasure to be able to serve you back and say, give me a shout if you have some questions, you're interviewing, you got some financial analysis stuff going on. Yeah, you took a managerial accounting course with me. If you have some analysis you want to see, call me for some free consulting and you're good to go. Happy to accommodate. I appreciate your time, your commitment this semester, and looking forward to helping you in the future if needed, as well as wishing you success as you progress in your career and education. Look forward to being in touch. Thank you very much.